Thank you very, very much for your attention and for your attendance today. Really grateful to be co-hosting this event with Blackrock and RVW Wealth. And I'm going to kick off today. Sorry. I'm going to kick off today before Mark Peterson and just tell you a little bit about our firm and some of the ways we add value beyond portfolio design. And I'll let Mark and then Stefan talk about some of the more technical issues of the portfolio design and construction. When you work with RVW Wealth, you work with highly technically trained professionals, CPAs, CFAs. And one of the things we do is help plan well beyond the scope of the portfolio. So I'm going to go through some of the planning techniques that we've developed and work with clients in implementing to help minimize income tax, because income tax is the largest bill most of us will pay on an annual basis. And if we can help you with your income tax, with your estate planning needs, as well as your portfolio design, we will achieve a lot. So the next dozen slides are ideas. Some of them work for you, some of them won't, but it'll give you insight into the way we think. So before I kick off, I just want to talk about what is an appreciated position? What is an unrealized gain in your portfolio? And we're seeing that a lot because of the high-flying FANG stocks or the cryptocurrencies, or people seem to have picked real winners of late and now are stuck with them without the confidence that those particular positions will continue to outperform in the future. And when you have an unrealized gain, what you really have is a tax bill that hasn't been sent yet. It's a bill in the mail. Hasn't arrived in your mailbox yet, but you'll have to pay it at some point. And I want to talk to you about some ways we deal with that unrealized gain. Okay. I'm struggling with that. Okay. So one thing we can do is freeze a position. And you can do that in a tax-neutral way. You can take a position and box it. And against that boxed position, you can now borrow and diversify. So you can actually neutralize a position, a particular exposure, something you've held for a hell of a long time that has a large gain, and eliminate exposure to the upside and the downside, then neutralize the position and borrow against it. And it's a common strategy we're using to help clients unwind highly appreciated individual stock positions. Simon, if you can go to the next slide. This isn't working. Sorry. Charity is another option. Charitable remainder unit trust, charitable remainder annuity trusts are common. These are ways for clients to unload individually highly appreciated positions in an extremely tax-efficient way, particularly those clients who have some philanthropic endeavor. And we're quite attuned to that methodology, modality, different ways to achieve that. Next slide. The other interesting thing we're doing is upstream gifting. And I just want to talk about this briefly, particularly in the face of looming and pending estate law tax changes. If you talk to your estate planning attorney, they're trained one way, and that is to move down one generation, down two generations. But there are sometimes opportunities when it's valuable to move money up to the great aunt who doesn't have much wealth. She's near the end. If she holds that position through passing, you will get a step up in basis and then have the ability to diversify the holding in the hands of whomever inherits it. So this idea of pushing back on the old theories of estate planning where you just push assets down, push wealth down, transfer wealth down, sometimes there's an opportunity to transfer wealth up to achieve a step up in basis on the death of that person, particularly with estate laws changing. Donor-advised funds are really, really great, especially this time of year. It works for almost everyone in the room. Almost everyone in the room who has any sort of philanthropic intent over the next 12 or 24 months should seriously consider a donor-advised fund. Donor-advised fund is a way of taking highly appreciated positions, gifting them to charity. Charity, as you know, are tax-exempt organizations. They can then sell and not pay tax. And then the proceeds are available for you to gift to the charities of your choice. Because they're public charities, you can actually fund organizations anywhere in the world, typically, and nobody pays the tax bill. So you get a higher deduction. The charity gets more cash, and the only one that loses out is Uncle Sam because no one pays the tax. Keep going. I explained this a little bit more, but skip that slide. Okay. The other thing we're seeing more and more is out-of-state trusts. As we know, here in California, we are paying our 13% state income tax. That is going up. There are some studies that estimate Under the new tax laws, us in California will be paying close to or in excess of 60% combined federal and state income tax. And if there are ways for your assets to leave California without you leaving California, that's a home run. And there are certain strategies that we will work with our clients and their counsel where their assets can move out of state while you continue to enjoy the balmy California weather. The other interesting strategy that we're thinking about and implementing, I'll hold questions to the end if that's okay. Other strategy we're thinking about is oftentimes you have a lot of wealth concentrated with one breadwinner, say a patriarch of a family. And that wealth or income is being taxed all to the patriarch at his or her highest marginal tax rates. And there are strategies where you can create partnership structures and transfer the income to lower earning descendants and therefore pay a much lower effective rate of tax. Go on, Simon. Position optimization. I should name my next presentation that and see who shows up. Position optimization is something that we spend a lot of time thinking about at RVW Wealth. Suppose we all decided that Dr. Feldman should have a 60% equity and 40% bond allocation in his portfolios in aggregate. It would probably be inappropriate to take all of his respective accounts and apply that same 60-40 to each of them. Because different assets live happier lives in particular account types. Your high growth, long-term investments should be in your IRAs or even better in your Roth. For kids, for home expansions, require bond allocations and therefore should be accessible in your living trust. By the way, with bonds earning nothing these days, the tax advantage of a Roth or an IRA applied to a effectively tax-free, because bonds are effectively paying nothing, although they are taxed. You're paying 50% marginal tax on 1% growth. Let's call that zero, although technically not correct, just for compliance. There's no point in applying this tax-advantaged vehicle of an IRA or a Roth to something which isn't earning any money at all. Let's reserve the tax-advantaged vehicles for things that will ultimately be subject to tax, like high-growth positions, i.e. stocks or equities. So the idea of applying a particular asset allocation to a client, we are all there. But we might put 100% of the equities in the IRA and 100% of the bonds in the living trust. Another step further on that. Your international stocks give rise to what's called a foreign tax credit. In other words, you hold stock in Toyota Motor Corporation. Toyota Motor Corporation pays Japan. As a shareholder of that Toyota stock, you will get on your 1099 a foreign tax credit. If that position is held in your IRA, that foreign tax credit is lost. It's gone. Because the tax-exempt status of the IRA or the Roth mean that you don't get benefit for the foreign tax credit applied. So what we would want to do, if possible, is to put the foreign positions in the taxable account so the foreign tax credits flow through to the taxpayer and give rise to a benefit. Simon? Keep going. And then who we are quickly. So we are fee-only fiduciaries. We are generally highly technically trained with CPAs and CFAs at virtually every client meeting. We are 17 professionals in 2 offices, and we manage just over $1 billion of client wealth custodied at independent custodians, primarily at Schwab Institutional and TD Ameritrade Institutional. We pride ourselves on our responsiveness and our availability, and for those clients in the room, I'm sure you can share some of that level of care, the fact that we go well beyond the portfolio design, which I'm going to reserve for the next portion of the conversation, just to tell you that we really care deeply about each and every client. And should you call us, we would welcome the opportunity to get to know you, your overall circumstance, your long-term objectives, and to think creatively about how we can achieve that in the most efficient way possible. So thank you very much. And with that, over to Stefan So, CPA, CFA, and friend and colleague of the firm.
Thank you, Jonathan. And obviously, there was a lot of good information that Jonathan went over. He has masters in taxation along with other very important designations. So to the extent that in terms of investment world, it's not about just what you get looking at it from a gross perspective, but it's also what you keep after taxes. So that's where we really strive to focus on. And on that note, I'm very excited to introduce Mark Peterson very soon. He's the Director of Research and Education at Blackrock, and we worked really well with him in the past. And I love his title because we really focus on education. That's what we really strive to focus on. And in terms of that, some of the areas we work on really closely is looking at the rules-based strategies that are out there that's reproducible going forward. So throughout a very simple example, there's a quality-based fund that we work with BlackRock. And what does that mean? So with quality, it means stable year-over-year earnings, meaning there's good amount of profits every year in a stable fashion. And for example, secondly, low financial leverage. What that means is basically low debt. You rather invest in companies that have lower debt than higher debt. So what it really amounts to is including companies, as you would probably recognize, like an Apple. Apple, for example, continues to sell their iPhones. I think everyone has iPhone or some sort of a smartphone, and it continues to generate sales. So that's where Apple comes into play. It's included because they have stable year-over-year earnings. Secondly, another company that's included right now is Visa. And thank you everyone for continuing to stimulate the economy. The way you spend, it's about 70% almost of the United States GDP. So very critical component. And because of that, Visa is actually included in this quality-based, rules-based ETF as well, because it has stable year-over-year earnings along with lower debt. And the performance has been very strong, and that's where, again, we work with Mark Peterson and his company very closely. So I'm pleased to welcome Mark Peterson. Thank you.
Great, thank you. Good afternoon. Great venue. Perfect, huh? I'm actually in Chicago, so this is a pretty good trade in November for me. It was snowing yesterday when I left, so don't have to twist my arm this time of year to come out to talk a little bit about the markets, talk about what we see at BlackRock. Inflation, anybody heard about inflation lately? Right, that seems to be the hot buzzword. My colleagues at BlackRock know that I've always fashioned myself as an inflation geek, which means I was really unpopular for 30 years, right? Now just starting to get back to where I'm useful again. So we'll talk a lot about inflation because I think there's a lot going on there. And I think it's going to be with us for a lot longer than folks realize, unfortunately. And I think there's more to the story. I think we've gotten a little bit complacent with inflation, right? We just haven't talked about it for years. I think folks just don't understand it, how it's changed, how it's evolved. It's kind of a different story than it's been in the past. So feel free to ask questions. You'll notice pretty quickly I'm kind of a chart and graph guy. I didn't leave many in Chicago, so we got a bunch of charts and graphs. Hopefully that'll help us tell the story. We do it through what we call our Student of the Market piece. This is something we do monthly to send to advisors across the country. And it's all to help with that education piece. And it's a lot, what we do a lot is lean on history. If you remember the old Mark Twain saying, history doesn't repeat, but it often rhymes. And I think you see that with the markets and the economies, right? Everything's always a little bit different, right? Certainly the last couple of years being a great example. But we can still learn lessons from the past and how the markets, how economies react to what we might be seeing today versus what they did in the past. So that's what we'll do. Again, fire away with questions. Don't be shy as we go here. If something doesn't make sense, always want to encourage that as much as possible. And certainly eat away. Don't be shy either. But let's jump in and talk a little bit about where we've been from an overall return standpoint, just for stocks and bonds. I don't know if you can remember all the way back to 2019. I know it's hard to remember anything prior to the pandemic, right? 2019 was a really good year for the markets. Stocks up 31%, bonds up 8.7%, right? Not too shabby for portfolios. Then last year, we followed that up. It's my fancy animation, screwing things up here. We followed that up last year with 18.4% for stocks and 7.5% for bonds. Granted, that 18 was a pretty wild ride, right? It was pretty rough in the first quarter of the year, then a big rally last 3 months or last 3 quarters of the year. But bonds 7.5%. So really good back-to-back years, 2019, 2020 for both stocks and bonds. We actually went back in the time machine and just looked at how many back-to-back calendar years in 95 years have we had that were that good, right? Well above average, right? Stocks average 10, bonds average 5. These are well above average for both. How often does that happen, right, in back-to-back calendar years? It's only happened 4 other times in 95 years. Think about how rare that is, right? Four times in 95 years where returns have been so high above average for stocks and bonds. And of course, that's a good news, bad news story, right? Good news is that's really good returns. Bad news is history tells you there's no third year. And that's the challenge. So we knew something had to give, right? Something had to give this year, and it was most likely going to be on the bond side, right? We're just not realistic to think about 8 and 7% bond returns when interest rates are, what, 1.5% on a 10-year U.S. Treasury bond? Right, that's just not realistically not sustainable. Stocks have continued to grind higher. This number is actually over 20% now, if we updated through last night. So it continued to be really strong returns on the stock side. But this was a challenge. We knew this was going to give here a little bit. And this is going to continue to be a challenge just because of that base interest rate. And we'll talk about that in a little bit later. Right? Just bond returns generally follow interest rates. So this is probably going to be a little bit more of our reality moving forward. But good backdrop, pretty historically rare. And just to dig deep on that bond side a little bit, if we can bounce ahead. Just to put it in perspective, I think this speaks well to bonds. We were down about 1.6%, and we're still right around that ballpark neighborhood. And it was the top 10 worst starts ever for bonds. Right? I think that speaks well to bonds, right? That you're down less than 2%, yet that cracks the top 10 worst starts of a year for bonds in 95 years. Right? That's a bad day in the stock market, right? Probably a bad couple hours in the stock market. But top 10, you can see some of the other years on there. 1994 was the worst year ever for bonds. Bonds were down a little bit less than 3% for the year. That's the worst year ever for bonds. We were probably that mark historically. We just put in, when they had a bad start, what they did the rest of the year generally looks pretty good. Of course, the challenge today is you're just not getting much income, right? That interest rate that you're generating off your fixed income is so low, it just doesn't provide much total return, or just doesn't add a lot to the overall total return. So I imagine we're going to see a lot more years in future years that are going to start to populate this chart, right? We're just going to have periods where bonds lose value because interest rates go up, and we just don't have a lot of income to offset that loss in principal and that price. So I imagine we had 2018 here, 2021. We'll probably have a couple years in the future that start to populate this chart. It's just the reality of a low interest rate world, right? Is you're just going to have more negative periods for bond returns going forward. Yep. Yeah, great question. The question was, do we see interest rates going up soon? Really depends on which interest rate you're talking about, right? There's short-term interest rates, long-term interest rates. Really, when you look across, it's not just the U.S., but across the globe, central governments are keeping interest rates low, right? They're trying to really stimulate economic growth across the developed world, right? Really big problems, obviously, in Japan, most of Europe, right, where they've kept interest rates really low to try to generate growth. So they're probably artificially low a little bit, but I think it's structurally something that's not going to change for a while. And we'll talk about it a little bit later. We've seen it in the past, right? It was different, but it was similar. Certainly reminds us of this period, right? If you go back to World War II, post-Great Depression, very similar rate environment. But I think it's a little bit our reality going forward. We call it lower for longer interest rates. But you could see short-term interest rates, which are absolutely zero right now. They could come up next year, right, if the Federal Reserve starts to raise interest rates on shorter-term interest rates, which wouldn't necessarily be a bad thing, right? We could actually get some money on our money market accounts and other things, but it's still little to nothing. But good question. Yep.
Perhaps you could make comments on how you recommend an adjustment on the stock bond portfolio in light of declining
Yeah.
returns on bonds.
Yeah, the question is just how do we adjust portfolios for that, right? The stock and bond mix. Yeah, I think that's one of the biggest things we talk about within Blackrock, right, is what makes the most sense. And I think we all know there's no perfect portfolio, right? It's each customized to our own situations. But we'll hit that on the end. I think it's a great way to wrap it up. But one of the realities, too, I'll just hit this one real fast here, is there's a lot of cash on the sidelines, right? We've never seen this much cash in money market accounts. Right? We just haven't spent money like we normally would with the pandemic, right? Haven't traveled, haven't gone out to eat, haven't done events like this. Plus all the government stimulus that's out there. There's record amount of cash on the sidelines. We're at about 4.5 trillion in money market accounts on the sidelines, and you can see where that is historically. And this is always a great indicator because you can see that whenever there's economic turmoil or stress, you get all this cash on the sideline that gets built up, right? Just everybody starts to flock to cash and worried about their assets, right? Trying to protect value. You can see it happen January of 03. Remember January of 03? That was post-tech bubble, post 9/11. You had 3 years in a row in which stocks lost money. Believe it or not, that can actually happen, right? 2000, 2001, 2002, you lost money. So you got up to 2.3 trillion, right? You can see pretty distinct peak there, right? Then January of 09, everybody remember January of 09? Global financial crisis. That was almost the exact bottom of the global financial crisis. I think the stock market bottomed in February of 2009. And there you had a $3.8 trillion peak in money fund assets. Right? So, and that didn't last long. And then last May we hit 4.8 trillion. And we really haven't budged much off that. We're still at 4.5 through the end of last month. So there's still a ton of cash on the sidelines. And when we look back historically, whenever you have a lot of cash on the sidelines, everything tends to do well. Risky assets tend to do well. Stocks, right? Real estate, we're seeing it in home prices. Look at following 2003. This is what stocks did per year the next 3 years. So think about that. Next 3 years, normally stocks average 10 per year. They did 16 per year following 03. Following 2009, they averaged 19% per year the next 3 years. Right? Just natural, these dollars start to find their way back into the markets, very supportive of prices in the near term. You know, the big difference, though, the caveat today is that stocks aren't as cheap as they were in 2003 after being down 3 years in a row, or at the bottom of the global financial crisis, right? We've had a great run off of the volatility of last year, right? So stocks are not cheap, and they were cheap during these periods, but we still think this remains, right? We might not get to 16 or 19, right? But we still think returns in the near term will be pretty good for risky assets. Just so much cash on the sidelines, just never seen anything like it, right? And you're seeing inflation everywhere, right? This is really the inflation story, right? Home prices up record levels, right? Stock market up at record levels, right? Cryptocurrencies at record price. You know, you go down the list and you can see it and feel it everywhere for the most part. One story within the stock market, and I won't spend too much time here, is just the tug of war between which stocks lead the market, right? Do you have those growth stocks, kind of those FANG names, right? Those technology, right? The Facebooks, the Apples, the Googles of the world leading. Or do you have some of the other, what they call value stocks, stocks that are cheap, right? Think of energy, think of banks, right? Those are all value type stocks. And it's been a tug of war over the last year. Which one's going to lead the market? And really, this has been the defining feature, I think, within the market. And you can see value outperformed fourth quarter of last year into the first quarter, and then growth came back in the second and third quarters of this year. And right now, it's pretty much even for this fourth quarter. Back and just look at 1 year periods. So this is just quarterly periods. If we look at 1 year periods, last August, we had the biggest growth outperformance in history over a one-year basis. So these tech stocks, right, everything that did well during the pandemic and the shutdown, they significantly outperformed some of those other places like energy, right? Who was using as much gas and energy, right, when during the middle of the pandemic when everything was shut down? Those stocks really got hurt, and it was the biggest outperformance ever in history, growth versus value. And whenever you see these extremes in the market, it tends to go back the other way, right? It's just the natural kind of law of markets in the economy, right? Think back to the tech bubble. You had all those technology companies outperforming, right? Look what happened, right? A little bit more 1 year later, a lot of those value stocks came back into favor. And I think we'll see, might not again exactly repeat, but we do think things like quality value will continue to do well here into 2022.
I have another question.
Yeah, we can probably grab the question now too.
When you talk about bonds, are you talking long-term, short-term, government, corporate?
Yep. Yeah, when we're talking about bonds, right now we're talking about everything.
One conglomerate?
Right, exactly. But mostly high quality, right? And that's one thing that's also helping keeping interest rates low. There's such a demand for anything that pays income. Insurance companies, right? Endowments, foundations. A lot of those entities have to have pretty conservative portfolios. And then you add on all those folks retiring, looking for safety, looking for stability. Globally, there's tremendous demand for anything that's high quality that pays a lot of income. But yeah, we can talk about some areas of the bond market if you'd like, right? Some of those areas like corporate bonds or high yield bonds, right, that pay a little bit more income. Great place, one of my favorites, but they're not cheap. They're just like stocks, right? They're pretty expensive relative to historical valuations.
Do you think we're in a housing bubble?
Question is, do we think we're in a housing bubble? Boy, that's a tough one, since I'm probably not the housing expert. But we'll talk about housing a little bit later. I think the answer is yes and no, right? How's that for a hedge? But I think it's an interesting dynamic because we are up 20% national average across the country on housing. The biggest we were up ever in the housing bubble was 14 and a half. So we're well past where we were at in the housing bubble. So it's an interesting dynamic. And again, it's inflation that you're seeing that doesn't actually show up in the inflation index, which we'll touch on. What do we got left here? If we can step ahead, is my clicker not working? Thank you. Here's the bond story, a little bit bigger picture. This is interest rates is the red line going back to the 1920s. So the red line is just where 10-year U.S. Treasury interest rates are at. And then bond returns by decade in the yellow bars. That makes sense? So just interest rates, bond returns by decade. And you can see the relationship here. Wherever interest rates start, right, that's generally where your bond return finishes the next 10 years. Right, so wherever interest rates start the decade, that's generally where bond returns finish. Not quite exactly perfect every decade, little buffer in there. My chart's not perfectly synced up. But you get the idea, right? And the challenge, of course, today is at 1.5% interest rates. That's the lowest we've seen since that 1940s, 1950s period. Right, 70 plus years since we had interest rates that looked like this. And I always say it's the ultimate financial irony, right? You have all these baby boomers retiring, looking for safety, looking for stability. And the safety and stability asset class looks like this, right? Probably one of the biggest challenges we talk about within Blackrock is this reality and what it does to your portfolio, right? And I think that's the challenge, right? It's how do you get income stability, safety, and diversification when bonds look like this. Part of it is still owning some bonds, right? Maybe you own some different types of bonds, right? Bring in that flexibility. But it's also going to be utilizing some other asset classes, right? This is not a silver bullet situation where we can say just buy this and it fixes this, right? It's just not that easy. It's going to be about incorporating other asset classes to get it done. Alternative asset classes, right? Other things that might pay income that might help get it done, right? Maximizing some of the strategies they talked about earlier, right? You're going to need better efficiencies than ever, right? It's less important, right, if your bonds are returning 12. but everything is more challenging when it looks like this. Yes?
If a client asks you,
Mm-hmm.
should I sell my failing bonds that are even below zero? Write it off on the tax. What would you tell them? I know you can't say yes or no, but
Yeah, the question is,
guide them.
yeah, should you sell your bonds? And certainly, if it makes sense from a tax standpoint, but it really is customized for everybody's situation. And I think this is the challenge. It's very easy to say, I don't want to own any bonds. But the challenge is, bonds still are a great diversifier for a portfolio. Whenever stocks are down, right, whenever stocks are negative for a year, bonds average a positive 5%, right? That's the beauty of diversification, right, is when one zigs, the other zags, and bonds are the ultimate diversifier. So even at low interest rate levels, they make sense, right, especially if you're looking for that safety and stability standpoint. But again, how do you balance and pull all those various levers to make it work for your situation? I think that's, right, I think that's why we're here, right?
Thank you.
What else? What do we got left? Trying to get to my inflation. Good stuff here. Just talking about diversification a little bit, I think it brings back the question about what should you own, right, from a portfolio standpoint. This is one of my favorites, and you can click a couple head here with my fancy animation. That's good here after this one. And we look at a diversified portfolio versus the U.S. stock market over the last 20 years and just break it out by the different periods, right? Just break it out by the bull and bear market periods. And it brings up an emotional reality that we always like to recognize, that a diversified portfolio never feels good, right? If you ever feel that about your portfolio, that, boy, it just never feels good. Just never feels like I'm getting ahead, right? It's natural. And it's because of this dynamic, and I tried to capture it with my fancy emojis here. You still lose money when the market's down, right? And probably no better example than 2008, right? That global financial crisis. This is a 60-40 diversified portfolio with different asset classes. You were down 24.5% in a calendar year in a diversified 60-40 balanced portfolio. One of the worst years ever for a diversified portfolio. Then if we click ahead to the next year, then the next 11 years, which can feel like it lasts forever, 2009 to 2019, look at how much the diversified portfolio trailed. Right, U.S. stocks were up 350. The 60-40 was only up 195. And we had so many folks wondering, right, do I have the right mix, do the right allocation? Should I have more stocks in my portfolio, right? Such a natural feeling. And then, of course, last year, look ahead the next couple, you can see we had last year was the exact same thing except in a condensed time period. But of course, the punchline here is if we add this 20-year period, and it's a little bit more than 20 years, how many would have guessed the diversified portfolio actually beat U.S. stocks over the stretch? Anybody would have guessed that? But for us at Blackrock, we call this winning more by losing less, right? Winning more by losing less. That sounds like a riddle a little bit, but it's really what we're trying to do with a diversified portfolio. You don't need all the upside, right, of what a bull market brings. Just get a chunk of it, but more importantly, protect to the downside. When the market gets choppy, economy goes into turmoil, right? If you can limit those losses, that's actually what builds wealth over time. It's just tough to see emotionally, right? Because these periods, right, 2009 to 2019 probably felt like it lasts forever. Right? It was actually the longest U.S. economic expansion in history. It wasn't the fastest or the biggest, but it was the longest from a time period standpoint. But for us, just a great reminder, right? Why we build portfolios the way we do, why we asset allocate and diversify, spread your investment eggs across a variety of investment baskets, right? It's all to get to this winning more by losing less story. Just tough to connect the dots, right, if you don't look at it this way. And it doesn't always work out this way, but this is just why risk is so important, right? And again, why a diversified approach makes so much sense. And think about this 20-year stretch too, by the way. Right? We've hit some of the events, right? Tech bubble, 9/11, global financial crisis, longest U.S. economic expansion in history, and oh, by the way, a global pandemic, right, as the cherry on top. Pretty historic period of time, and look at how well the diversified portfolio did. We think a pretty compelling story. So let's finish up now with inflation, my favorite topic. Again, makes me a hit at all the cocktail parties now. Get on my inflation soapbox. It was 6.2%, 1 year change in inflation at the end of October. So this number is actually a little bit old, 6.2%, even higher than the 5.3 we had at the end of August and September. And it's not just inflation is the challenge today. I think everybody in the media misses this fact. It's not just inflation. It's the fact that interest rates and savings rates aren't keeping up. Right? Normally in the past, whenever inflation, remember when inflation was at double digits in the 70s and 80s? You also had double-digit interest rates to keep pace with that, though. Right? Normally, interest rates keep up with inflation. That's not happening for some of the reasons we touched on. Right? Bonds at 1.5%. It's the widest gap between inflation and interest rates that we've seen in 40 years, right? This is actually the line, just the difference between where inflation's at and where interest rates are at. That gap is 4%. You have to go back to June of 1980 to find that big of a gap between those two. That's a challenge, right? That's one of the biggest challenges of today's inflation world, right? If interest rates kept up, we'd be getting more income, right? Bonds would take a hit, but they'd at least be paying something again. We don't see that reality happening anytime soon. Because normally, if you look at these periods, they tend not to last long, right? They tend to fix themselves, right? Interest rates come up or inflation comes back down. I think everybody was expecting inflation to come back down, but that's just not in the cards, I think, at this point, right? Too many factors challenging inflation at this point. But I think this is one of the biggest stories that goes untold, right? Just that difference between the two makes it hard, right, to keep up with inflation. Last slide we'll touch on, and this really goes to the housing market question, not my punt. Here's housing prices, right? This is end of July. It's actually over 20. And that's the biggest, right? We were 14.5% at the height of the housing bubble back in September of 2005. So seeing huge gains in housing, and that's for a lot of reasons. I think one of the biggest factors there is post-global financial crisis, all the home builders got wiped out, right, for the most part, especially the region and local folks. So there has not been nearly as many homes built in the last 10 years as the previous 10 years, right? So there's just no supply in the market, and probably no better example than, right, Southern California than no supply in the market, right, than this area. So that's created a big supply-demand imbalance in housing. But this is an interesting inflation story because there's no longer housing prices in the inflation index. Anybody know that? They don't include that 19% in the inflation index directly. They actually made that change in 1983. Remember, that was when, late 70s, early 80s, we had periods of high inflation. They took housing prices out because interest rates were going down. Even though housing prices were going up, it was getting cheaper to finance a home, right? So they took housing prices out and they replaced it with what they call homeowners equivalent rent. They actually ask you, what would you rent your home for? And I don't know if we have any landlords in the audience, but rents don't move much, right? Even areas like this, rents don't move real quick. And that's the yellow line. Look at the rents over the years versus housing prices, right, which have been crazy. Rents are almost flatlined, right? And this is the reality of the inflation. We've got 6% inflation. That doesn't include the housing market, it includes rents. This is actually the biggest portion of the overall inflation index. It's about 23, almost 24% of the index, is they ask you what you'd rent your house for. And actually that overall housing shelter component is 40% of the inflation index. Right? So they talk about food and energy, and certainly we can touch on it, but it's a big housing index, yet it's not really housing, it's rents. Think about, there's actually some inflation calculations out there that go back and say, well, if you calculated it the old way, inflation wouldn't be 6%, it'd be about 14% using the 1980s calculation, because you'd be using housing instead of rents. That's my deep dive on inflation. But yes?
A few slides before,
Yeah.
you had the diversified
Yep.
What is, in your mind, when you calculate this,
hmm
what is a diversified portfolio when you come up with these percentages?
Yeah, we use just kind of a general 60 stock, 40 bond, and we use kind of the breakdown of what the industry looks like, right? So there's corporate bonds in there, there's different kinds of things in there. There's some small company stocks, there's some international stocks in there as well, right? I think that's what we're talking about broadly, but obviously we can take that another way. Like the quality stock example is a great example, right? I think that's the next evolution of how we diversify. We can specifically focus and say, hey, we want to add quality stocks to the portfolio because they're a good diversifier for a lot of reasons, right? They'll do well when the market doesn't do as well, yet still get some of that upside that's important. But yeah, no, I think it's, right, diversification more important than ever, right? Because of the challenges, especially on the bond side that we touched on. Yes, sir.
Why do you pick up starting the 2000 to 2020, not the 1990 or to start or 2010 to start?
Yeah, no, I think, why do, and certainly, we use this period because it looks really good, right, for the diversified portfolio. But really what's key here, why this chart works, honestly, is the big negative bear markets. The big bear market, you would have to diversify. Just own stocks, right? If bear markets were only 20% down, own stocks. But the challenge is that doesn't happen, right? You were down, and some of these numbers were a lot bigger than this, right? We were down at one point in this bear market over 50%, or I should say the global financial crisis over 50%, right? That's what makes this chart work, because what's the reality is the investment math, right? If you think about it, if you're down 50% one year, right? If you have $1 that goes to 50 cents, what do you have to be up the next year to get back to break even? You probably didn't think you were getting a math quiz today, but you got to be up 100, right? You got to double your 50 cents. So that's the combination. Minus 50 up 100 is the investment math. But what if you're only down 10? Anybody know? We got any math geeks in the room? If you're down 10%, what do you have to be up? We got a math geek. 11. You only have to be up 11.111111% to get back to break even. That's kind of the reality of the investment math, why this winning more by losing less works. Right? If you can limit the loss, it limits the portfolio's impairment, really, right? Once you get bigger losses, right, it really starts, you've got to be up 100% just to get back to break even versus only being up 11, right? If we can turn the 30s into 20s and the 37s into 24s, right, that's how we win more by losing less. So, again, you probably weren't expecting the math quiz before the rest of lunch here. What else? Inflation across the board, like I said, is pretty broad-based. Right, when you look at it, food is really high. Meat just is following inflation over the years. It's really wide spread across the categories. It's not just the supply chain issues, and we do think it's gonna come back. There have been areas where clearly the pandemic's played havoc with prices. Right, some of those areas are going to come back down, but we have other areas where we think they'll stay elevated. Right, so it might not be 6% or 5% inflation, but it's probably going to be 3 or 4% inflation, right, versus 2, which we had for 20 years. So we think it's going to be higher than recent inflation, and most importantly, still much higher than interest rates, right, again, which creates that challenge. Yes, sir.
When you're comparing value to growth stocks, are you looking at total return or stock price?
Yeah, when we're comparing value and growth, we're looking at total return. We're always looking at total return just to include everything, because value might give you a little bit more income, right, versus some of the growth companies that are reinvesting those dollars. Anything else?
Unrelated.
I think for the next portion, we're going to do a Q&A.
Okay. Yep. I've already stole some of the Q&A.
That's all good. It's on Steph. Stefan's a good question.
Just a few more.
And lunch is on its way.
Yes.
I'm sure, as you can see, this is why we love working with Mark, because he has a wealth of knowledge, and the way he explains it, it's in a manner where everyone could understand. So I know one of the things that were brought up is looking at it from an investment landscape, because at the end of the day, we need to figure out how do we continue to perform at a good pace. And so, speaking about that, we did mention looking at it from a lens of quality. And what that means, again, is how do companies look from a balance sheet perspective, really how you would buy businesses, evaluating factors like profitability and revenue and so forth. But in the light of inflation, what factors or what areas would you focus on to make sure that your portfolio continues to perform?
Yeah, I think you hit quality. I think, we mentioned value. I think it's just poised to bounce back quite a bit. So I think those areas of the stock market will do well, right? It's just energy. Energy's been one of the worst performers up until recently. It's the best performer this year. So it's bounced back in a big way. So I think those areas make a lot of sense. I mentioned the quality call we like a lot. And I would just look at areas of the market that almost do what we talked about, that winning more by losing less story, right? So not necessarily super high flyers that are going to hit the home run, right? But stock and stock categories that give you a good chunk of the upside, right? But it'll do better whenever the bear market comes. When we look at portfolios across the country, that's generally folks that don't own a lot of those type of stocks, right? That aren't real glamorous, right? But it'll give you a good chunk of the upside, maybe not all of it when the market's really good, but more importantly, will do better in a downturn. And that's quality fits that bill. Value generally fits that bill. Lower volatility stocks fit that bill. So I always like that profile. I always think it's under-owned in portfolio, especially right after we've had such a big run in stock prices here the last couple of years, and especially since last March.
Yes, absolutely.
Ask a question.
Yep.
Is it not true that your company advises the ETF diversification in growth countries in relation to ETFs in the United States? Like India,
Mm-hmm.
and based on that information, India's gone up like 23%. You guys advise that. Do you have any comments on that?
I don't. I'd have to dig a little bit deeper. Exactly. I mean, Blackrock has a pretty big footprint. We're the largest asset manager in the world. Oh, I'm sorry. Just Blackrock's activity in some other countries, right, in our business, India in particular. I'd have to look at India specifically. Yep. Yeah. No, certainly we've got business and expanding over in places like that to try to help some of the retirement challenges because they're, behind us by a pretty large margin. Oh, absolutely, sure. Everything. But I can tell you, BlackRock as a firm, we only manage money for clients. So we have exchange-traded funds, mutual funds, and other, separately managed accounts. So everything we run is for the benefit of the client, right? We don't have, things that we run for ourselves or like some of the banks have, right? Private institutional investing business that they do for themselves, if that helps at all.
Right, and on that note, I think it's important to look at it from the lens of a U.S. investor. And so when certain investments come in to light and to inception, there's a lot of, it's interesting, within the U.S., more U.S. investors invest in equities compared to other parts of the world. And so I think that's what you mean, where if you're looking at sort of the macroeconomics, seeing the flow of money, and obviously with the United States being more equity-heavy investors, that definitely helps. And I know food's coming soon, so I'll wrap it up with a few more questions. In light of looking at, again, inflation, I think one of the things on top of clients' mind is also looking at it from a perspective of inflation expectations going forward. So normally it's been around, let's say, a 3% mark. I mean, how do you see that going, changing going forward?
Yeah, I think that's normally when we think about investment plans, right, investment planning, you have an inflation assumption in there, right? And I think for years it was always around 3%, I think was the common, what we see most folks use, right? Because that was kind of the 90-year average for inflation, even though the last 30 years has probably averaged 2%. Right, you just put in 3 just to be safe. Now the question is, and it's a good one, right? What do we use going forward, right? If this world if it's not going to be 6, it's not going to be 5. Is 4 the new number, right? Is 4.5 the number to be safe? Is 5 the number to be safe, right? And I think that's you know, we're talking 4.5, right? Is probably the new reality, right? Which starts to change the math a little bit again, especially given the fact that rates aren't keeping up. So, yeah, I think that's a big challenging dynamic in portfolios. Is you might not sound like a huge change from 3 to 4 or 5, but you start playing that out over 10, 15, 20 years, and it moves the needle in a big way.
Right, and of course, then comes the importance of asset allocation. I know we spoke quite a bit about S&P 500, and for those of you who might be unfamiliar with, it's really looking at the large 500 companies in the United States, and really with some certain companies like Apple and Microsoft leading the way into the trillions of dollars in valuation. That really has changed, and I think one of the most important lessons is if you're looking at that grouping of companies from years 2000 to 2009, it was really one of the only major indexes that lost money after 10 years of investing. Some of you don't remember this company anymore, but Cisco, for example, I know, was the largest holding, I think value well over $600 billion at one point in 2001. I think it's about half of that now, 20 years later. So could you just speak a little bit more about the importance of diversification, looking at it from a size perspective?
Yeah, no, absolutely. This is probably the only slide I don't have lately, but if you look at the top holdings in the U.S. stock market over the years, it's a fascinating history of the U.S. economy, right? GE for years, right? And now you moved into today's technology world where you had energy companies dominate for a stretch of time. So it's a really fascinating look, just looking at the top 5 or 10 companies in the index. But we've seen that last year was such a top-heavy year for the stock market. The top 5 stocks, right, which is Facebook, those FANG names, Facebook, Apple, Amazon, Google, right, they all benefit from the shutdown. They were up 53% last year. The bottom 400, right, number 101 through 500, were up about 9, right? So 52 to 9 was how top-heavy the market was last year. Much more equal this year. Granted, Tesla's helped the top 5 because Tesla's popped into the top 5 and throwing off my numbers. But this year, you're seeing those bottom 400 stocks, they're up probably closer to 30% this year. So that benefit of diversification by cap size certainly has helped this year. And I think that'll continue, right? It's a healthier sign when there's more companies doing well, right, in the market and the economy. You don't want to just have, right, 3 or 4 companies or 5 companies drive the day, right? That's not healthy.
Thank you, and that's where we come in and work closely with Mark and his team. And just to give you a comparison point, S&P 500, again, lost about 9% in that 10-year time span from 2000 to 2009. How we really get around that is looking at some of the other areas. So S&P 400 is actually the 400 mid-sized companies in the U.S. That was up around 80%. Same with the S&P 600, which happens to be the 600 small companies in the U.S. So the way we work together is really look at how the companies are positioned and then tilt towards certain factors that outperform over time. So thank you again, Mark, for the wonderful presentation.
Yeah, thank you, everybody. Great questions, and enjoy your meal. I felt like I held up your meal too long here.
Why don't we quickly introduce the people from the organization who are here so you know who you can ask or address questions to, Steph, once you give out the intro.
Yes, absolutely. So Jonathan Gerber, who's one of the founders of the firm, expert CPA, along with other designations, he spoke first. My name is Stefan So. I'm the Chief Investment Officer of the firm, really focused on the due diligence side of the investments. And we also have Mike Chen. He's one of the senior analysts, one of the gurus, if you will, in terms of looking at the portfolio, how we could potentially improve it, also and looking up from a tax perspective as well. And we also have Ofer. He is one of our advisors. He works very closely with a lot of the clients in the Orange County area. So if you're from this area, he'll be happy to assist you and really look into the portfolio and see how we could improve things from there. And we also have Simon, who's helping with the technology today, but he is our lead trader as well. So making sure that from an execution perspective, when you're looking at some of the positions and going out to the market, you might not actually get the best pricing, just depending on how some of the positions are moving. And so what we do is go out and get the best pricing on your behalf. And that's what Simon really focuses on. Yeah, absolutely. So Assad is also one of our partners. He's from Blackrock. We work also with him very closely. And what we do is regularly looking at from our portfolios and seeing what changes we want to make in light of how the economy is changing and so forth. So Assad, thank you for your time as well. Great.
And we're around, so please pick our brains, step aside, pull us aside. We're here. Enjoy your lunch, and thank you. Thank you very much for spending your lunchtime with us today. We appreciate it.
Thank you, everyone.